Good evening, friends. Welcome to Maruti Coaching Center. Hi, this is TGS. It's always been our endeavor to help you, isn't it? Right from the classroom, right through your exam holidays, through our model exams, now just the day before exams, and even after you finish your exams, we will help you in finding out a right audit firm. Not only that, after your final classes, because we'll be with you in the final classes, after your final classes, once you become a chartered accountant, we'll shape your career. That's what Maruti is all about. We are not going to be there only for exams, we'll be shaping up your career. So in that effort, what we're going to do now is, through this small video sets, in the next 48 hours, you're going to face your examination. Right, you don't know what to do in the last 48 hours. So what I'm going to do is give you a quick opportunity to recap most of the important provisions which is likely to be there in the exam. After these videos, you can watch it anytime to practice some of the problems from our book, both workbook and textbook. I'm sure that all of you will end up in more than 70, right? So let's begin this with income from house property. So in this video we will find 1. What are the conditions to be satisfied to commute income from house property? 2. How to compute income from house property? 3. What are the other provisions? Let's begin with the charging section. What circumstances will a particular income will come under highest fee? As per section 22, it's the annual value of the property consisting of buildings or lands appurtenant to buildings of which the assessee is the owner, excluding such portions which are used by him for his own business or profession, is going to be taxable instead of income. So what does it mean? 1. You need an annual value. That's given by section 23. The property must consist of buildings or lands appurtenant thereto. What does it mean? You cannot bring income from vacant land to tax in this state of income. 3. The assessee must be the owner. What does it mean? So in case if the tenant sublets a property, this cannot be brought to tax in the high HP because he is not the owner. The last point, the property should not be occupied for own business or profession. So in case if the property is occupied for own residence, and in case if it is let out for somebody's business, it's very important note, the same will be taxable under high HP. So just to summarize, there are 3 important points. There must be annual value. The property must consist of buildings or lands appurtenant thereto. The assessee must be the owner. The property should not be occupied for own business or profession. Right? So what is taxable income from house property? Which is the annual value. The annual value is given by section 23 of the Income Tax Act. For this purpose, you need to bifurcate the properties into A. Self-occupied, B. Deemed to be let out, and C. Let out. You all know what is the self-occupied property deemed to be let out. I'm not going to dwell upon that. So the annual value of a self-occupied property will be taken as 0. But in case if the assessee has more than one house, he can take only one of them as 0. All remaining houses are going to be considered as deemed to be let out. And in respect of deemed to be let out, there are 2 steps in arriving at the annual value. What are the 2 steps? Step 1, compare the municipal valuation with fair and take whichever is higher, which we can call it as step 1, municipal valuation or fair and whichever is higher. Then compare the step 1 with standard rent. Step 1 of standard rent, whichever is lower. So this will be your second step in arriving at the annual value. So there are 2 steps for a deemed to be let out property. In the case of a let out property, you add one more step to the same. The third step will be the actual rent received or receivable. But if your step 3 is more than step 2, which is actual rent exceeding the expected rent, then actual rent will be the annual value. So what if your step 3 is lower than step 2? You have to find out, is it lower on account of vacancy? If it is lower on account of vacancy, then once again the actual rent of step 3 will be the annual value. In any other case, it's going to be the step 2 which will be annual value. So I'll just run through the steps of let out property again. Step 1, same, municipal valuation of rent whichever is higher. Step 2, step 1 or standard rent whichever is lower. And what is step 3? If step 3 is the actual rent, if S3 is greater than S2 or if S3 is less than S2 on account of vacancy, step 3 will be your annual value. In all the cases, step 2 will become the annual value. So you can listen to this video any number of times so that it goes through your mind. Now this is only the first stage. So from the income, you are allowed certain deductions, and then the final amount is going to be your income from house property. But it's going to be a self-occupied property. It's going to be very, very simple. Annual value 0, only one deduction for interest on capital borrowed. The balance will be your income from house property. It goes without saying that amount is always going to be 0 or lost. For let out and deemed to be let out, there are 3 deductions are available. Apart from the interest on capital borrowed, you also get deduction for property taxes and also for standard deduction. So let me go through one by one. In the case of a self-occupied property, the annual value is 0. Only one deduction is allowed, which is interest on capital borrowed, which you can claim up to 30,000 or 1,50,000. If you want to go up to 1,50,000, you need to satisfy 3 conditions. The 3 conditions are going to be based on 1, the date on which you have taken the loan, the purpose for which you have taken the loan, and the time you have taken to complete the property. First point, the date of loan. The date of loan should be on or after 1/4/1999. Then go to the second condition. The purpose of loan should be for purchase or construction. Third point, the purchase or construction should be completed within 3 years from the end of the financial year in which the loan was obtained. Alright? The key point there, the date is not relevant. It's end of the financial year, 3 years from the end of the financial year. Take a simple example. If the date of loan is 1/4/06, it's not 1/4/09 cutoff. End of the financial year 31/3/07. 3 years from the end of the financial year 31/3/2010. Right? Go to the other 2, let out and deemed to be let out. There's 2 steps for arriving at the annual value of deemed to be let out, which you can call it as a gross annual value. There are 4 steps in arriving at the annual value of a let out property. That's going to be called as a GAV or gross annual value. From the gross annual value, you should deduct property taxes provided 2 conditions are satisfied. What are the 2 conditions? Condition number 1, the property taxes must be actually paid during the previous year. And 2, the same must be paid by the owner. If 2 conditions are satisfied, you can claim deduction for property taxes. The amount which you get after the property taxes is also referred to as net annual value. Is it end of the computation? No. There are 2 more deductions are available under section 24. 24A is a standard deduction. 24B is interest on capital borrowed. The standard deduction is basically given for meeting all costs relating to house property like repairs, etc. So it is available at the rate of 30% of NAV. What needs to be noted here, you don't have to spend even 1 rupee to claim deduction. The second and last deduction is the interest on capital borrowed. The 2 points which you need to take into account. Unlike property taxes, interest on capital borrowed can be claimed as deduction even if you don't pay the interest. It means you can claim on due or accrual basis. What is the next important point? The interest on loan can be claimed as deduction even if you borrow from your friends and relatives. There is no conditions here. You can borrow from anybody. Still you can claim the same as deduction. And last but not the least, unlike a self-occupied property, the interest on capital borrowed has got no limit for let out or deemed out. There is absolutely no limit. You can claim any amount as deduction towards the interest on capital borrowed. So your NAV minus these 2 deductions is also called as income from house property. Right? So in this subsequent video, we look into other important points in income from house property. For the time being, goodbye.